Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Walker Meadows. Thanks for being on the show, Walker.
Hey, Whitney, glad to be here. Thanks for having me on.
Walker's superpower is building financial models to underwrite mobile home parks. He leads the acquisition efforts at Open Door Capital, Brandon Turner's mobile home park investment company. Prior to discovering his passion for real estate, Walker worked various corporate finance, engineering, and account management roles across multiple industries. He lives in Atlanta, Georgia, with his wife and newborn twins. Again, congratulations on those twins, Walker. That's incredible.
Thank you, Whitney. Yep, we're glad to have them as part of the family. Hopefully they'll behave for the remainder of this call.
Yeah, hopefully they will. And it's okay if they don't. But Walker, I'm looking forward to just jumping into some mobile home park underwriting. And as a syndicator, as a deal sponsor that's focused on mobile home parks, it's a great topic. I'm hoping the listeners will tune in and perk up to, especially the ones that are looking at mobile home parks. But give us a little more about your transition, from the corporate world to where you're at now, and let's dive into this underwriting this type of asset class.
Yeah, so kind of in like a 60-second nutshell. I'm a degreed mechanical engineer and went back and got my MBA. Started out my career in some process engineering type roles with some larger pharmaceutical companies, and then transitioned into more corporate finance and account management type of roles specifically with electric utilities here in Atlanta. Picked up the real estate bug like everybody else a few years back, just through listening through content online, wanting to break the 9-to-5, stuff like that. And so Brandon Turner from BiggerPockets, I'm sure a lot of your audience probably knows him, put out on his podcast it's been about a year and a half ago probably now that he was looking for some folks to help him underwrite. That's always been a super strong skill set of mine is financial modeling. So I reached out to him along with a ton of other people and made it through their kind of rigorous process and worked part-time with him in addition to my day job, probably 20 or 30 hours a week for about 8 months or so. And then just in January of this year, I finally jumped ship at my day job and am doing this full-time for him. And so I do everything on the acquisitions front, from lead gen, underwriting the deals, the due diligence process, managing the lender and lender relationships, and as well as with our lawyers. So really everything up to the closing table. I would say the majority of my experience coming into this role, I had done a couple of flips here in Atlanta, but the majority of my experience is on the kind of in-depth financial modeling side, and just kind of applied those concepts to real estate.
So how did you train yourself? How did you teach yourself to do, this type of in-depth financial modeling?
Yeah, that's a good question. A lot of time and a lot of just kind of banging your head against the wall, to be honest with you. So a ton of self-education, obviously. Probably read 20 or 30 books on the topic and a ton of Udemy courses. And
what courses? What kind of courses?
Udemy. I believe that's the name of it. They have a lot of kind of online self-education type of, that really on any kind of topic you want to look at, but specifically they have some on kind of the more sticky components of the financial net, like waterfalls and how to incorporate promotes and waterfalls into your analysis and stuff like that. And I would say I had a lot of the building blocks already, just that I had developed throughout the course of my career, through various past positions that I had and experience that I had with Excel and financial modeling within those. So it was really just kind of the real estate specific side of the financial modeling that I had to get my head around.
Are there a couple books, maybe you said you read 20, 30 books about it. Are there a couple or a few that you would say, if you're going to be in this business and you want to know about underwriting like this, you got to read this book or these few books?
Yeah. To be honest with you, I found the Udemy courses even more helpful than the books. While we're talking, I'll try to pull up the exact name of the one that I'm thinking about. the books are kind of a dime a dozen. I don't have one that sticks out in my mind as being I would recommend it above all else. It's really just grabbing any kind of book that can break down real estate specific financial concepts for you. So how to calculate cash on cash, what is net operating income, how are commercial properties valued. I would say just grab a couple and dig in.
So just so the listeners know, I just looked it up and it's udemy.com.
Exactly.
Interesting. So is it just all online? You look up any courses you want, you pay for the course and watch videos about it, or?
Yeah, exactly. And I think the course I looked at that I watched was $14 or maybe even less. I mean, it was really, really cheap, but it was super specific, kind of in-depth Excel based information, which is really hard to find, believe it or not.
I appreciate you sharing that. That's very valuable, especially that inexpensive. I mean, it's well worth your time.
Yeah,
no doubt about it. So, rigorous process you mentioned, and you mentioned working 20 hours a week, and was that for Brandon?
20 to 30 hours a week on top of my day job for about 8 months.
So on top of your day job. So, I just want to sit there for just a minute and say, just the effort that you put in to make this happen, right? And I think a lot of people minimize how much work it's going to take to get into this business sometimes. And could you just highlight, going into that, did you realize it was going to be that much work? How did you manage that time? And especially, you were married at the time, maybe no kids yet, but you still had a spouse at home that probably was wondering where you were at.
Yeah. And it was kind of a crazy time in my life because I was also in school and had an education business I was running on the side as well. And it was like, it was pretty hectic. And that's what I tell people. I think it's a great way to get involved in this space is to find somebody to latch onto and provide value to in that way, specifically around underwriting, because I think it's a pretty valuable skill set and somewhat rare. And, the way I kind of frame it to folks as an order of magnitude, I'd say like, are you willing to work for somebody for free for a year, just flat out free, 30 hours a week for free for a year? And if they say no, then that's probably because in my mind, it really takes something to that extent or a good bit of money, to invest in a class or something like that. So it's like, do you want to put in 20 grand and maybe 3 months, or are you willing to work for a year for 30 hours a week for free? And I found that to be a pretty good stress test to filter out people that are willing to put in the work. I didn't know the order. Yeah, I didn't know the extent of the hours that I would be working when I got into it. But what I did know was that it was a great opportunity, and I was willing to work for free for as long as it took to get on board. Recognized the opportunity, didn't really know how that would translate into hours worked, though.
I think it's probably better that way sometimes.
Yeah.
But the cool part is that you notice the opportunity and it's like, okay, let's do it. This is a great opportunity. Let's jump on it. It doesn't matter how many hours, right? I'm not going to, I've got this individual asking me or telling me that I can work with him. The last thing I'm going to do is go say, well, I can only put in 2 hours a week. Is that okay?
Right. Yeah. And I think something you also see too is working as long as it takes for free without any expectation of any kind of financial gain, which I think is a huge disclaimer to put on the end of that. Because you see it time and time again that folks come in too heavy-handed on the compensation side of things, especially right out of the gate. And I think it's a pretty short-sighted way to look at things. If you look at the lifetime value of the education that you get with working from a syndicator for a year, it is 100, 200, 300 times more valuable than any kind of compensation you could have received throughout the year. So that was the kind of approach that I took. And I think that would be a valuable little nugget for folks out there that are looking to do the same, bolt themselves onto an existing syndicator to gain knowledge.
No doubt about it. It's an amazing way to get started. It's definitely one of the best ways, if you ask me. And that person turns into a mentor, right? You're going to learn so much, like you just said. It's a great way. So, Walker, let's jump into underwriting a mobile home park. and maybe you can use either a previous deal or something, and you can kind of highlight, how we go through this process, and maybe just your process, of how you do this to ensure that, this is a good investment or not. And maybe we'll talk about how you structure it a little bit, maybe what's different between mobile home parks and, other asset classes, that's, specific to, the numbers you're looking at. But get us started. Either way, previous deal or a fake deal, either one, if you don't have one you can share.
Yeah. It might be more helpful if I can just run through if we come across a deal from a broker, wholesaler, or otherwise, kind of soup to nuts, how we take it through the process.
Please.
And that might be helpful. And so you can kind of think of it as a filter. We kind of have multiple sniff tests that deals go through before they ever hit the underwriting model. And obviously there's the preliminary filter where you're looking at a deal, it just doesn't meet our criteria. But kind of the three things that we're looking for right out of the gate are the park needs to have over 100 pads. It needs to be city utilities, so no private wells or, septic tanks, anything like that. And it needs to be in a population with ideally at least 100,000 people and steady population increases. So those are kind of what I think of as our first layer sniff test. That will filter out 90% of the deals, which originally folks think is bad, but we found that the more specific we can get with our criteria, the better, actually. The quicker you can get to a no on a deal is just as effective. It's just as important as getting to a yes, because you only have so many hours in the day, and you need to be able to filter down to the high priority deals. So I'd say that's the first level filter. And next level filters, we take it through the kind of full blown sniff test, which is where we are looking into demographics of the market. We're looking at median income, median home value in the area down to the specific zip code and block level. We're looking at the economic kind of outlook for the area, job projections, and all the standard demographic criteria that you would expect probably in any asset class, kind of the market drivers. And really the main one behind it all is like, are there jobs there, and will there be jobs there in the future? So will you have people to sell your product to? And then if it gets all the way through both of those, then that weeds out probably 99% of the deals. And so we're really only hyper focused on the 1% of deals that will check our boxes. And so at that point, basically when I came on board with Brandon, I rebuilt our entire financial underwriting model. And that's what we currently use to underwrite deals. And so at that point, is that an Excel sheet? I mean, something you've mastered, or is that okay? It is exactly. Yeah. It's an Excel spreadsheet. It's pretty complex behind the scenes, but we tried to make it very user friendly on the front end so that multiple team members can use it, even if they're not getting a ton of reps on underwriting a deal. But I mean, if it gets to that point, we are getting full blown financials from the broker, from the seller, to the extent that we can. We're getting rent rolls. We are having multiple phone calls with the seller and with the broker. Typically for a deal we take all the way through the underwriting process, I mean, it can take 10 to 15 hours, soup to nuts, before we get an offer out the door. And that's why it's so critical that we only let the high priority deals through to that point, because you
can only get through so many.
Exactly.
Right?
Yeah. I mean, if you just look at my hours in the week, even if I worked 80 or 90 hours a week, we could still only get so many offers out. So we got to be hyper selective on the front end, which was a learning curve for me. I felt like we were leaving a lot of meat on the bone.
I liked how you said, and correct me if I'm wrong, you said that the quicker you get to a no is as effective as getting to a yes. Is that right?
Exactly. Yep. Because every second that you spend mulling over some deal that ain't going to work for you anyway is a second you could have spent evaluating a deal that is going to work for you.
That's awesome. So, all right. So now you found that one deal that, meets all that criteria, that 1%, right? And then now it's time to dig deeper. So has over 100 pads, has city utilities, population of at least 100,000. You've checked the market out. You checked the economic outlook. There's good jobs there, and jobs are going to be there in the future. Maybe you could mention one thing about what tells you that jobs are going to be there in the future. Is that a specific kind of job? What would tell you that?
Yeah. I mean, we typically like to see a diversified basically when you look at the job outlook, you want to see a diversified job outlook, meaning that the area isn't super dependent on one singular Air Force base or one singular manufacturing plant, to limit your risk there. And really, I mean, you kind of have just past job growth information and kind of ancillary information you can get from local economic development groups to project out into the future. You know, they say past data isn't always the best, indicator of future performance, but to some extent, that's the best we have in this space. And so a lot of times you're using past population trend data, past job growth data, and any kind of projections you can find online.
Okay. So now you found this deal. You know, what documents do you already have, to have gotten this far?
Yeah. If it's a broker, so that's a kind of an interesting point to dive in on, because especially in mobile home park world, you know, a lot of parks are still owned by what we call like mom and pop type of sellers. You know, they might be 70 years old looking to retire. They've owned the park for 50 years. And they might keep their books on a notepad of paper, and that's it, you know, and that's what you get. And so that's kind of one extreme. Another extreme is a very professionally marketed deal through a large broker where you have a nice, professional looking, OM, and you have a T12 financial statement along with the current rent roll. And a lot of times even additional information on top of that, you know, maybe prior years, financials as well. And it really just depends on where the deal is sourced. Sometimes we don't have any of that information. We have to make some broad level assumptions. But ideally we have at least a T12 and a rent roll to reference.
Okay. Yeah. In an ideal world, right? But would you rather have a deal from a seller who is just using a notepad though?
Yes. Yeah. And even though there's more risk on we like to joke, you know, there's an inverse correlation between how professional the financials are and how good the deal is, typically. So it's not always the case, but we get much more excited whenever we see some handwritten financials, because that means that it hasn't been professionally managed, you know,
right.
There could be more potential upside for sure.
They've not optimized everything they possibly can. That's for sure.
Obviously.
Right?
Yeah.
They're probably not thinking that way. And it's not just on their bookkeeping, right?
Right. Yeah, precisely. Yeah. Yeah. So even though we might have to make some more assumptions in that case, generally the deal can be a little bit more profitable. But yeah, so that's kind of the documents that we have in hand at that point. And it kind of starts with a deep scan through those documents before we even open the underwriting model. So we are looking at the T12. We're looking not just at the year, you know, the past 12-month total values, but the trends over time. So if water and sewer was 10,000 one month and 2,000 the next month, and then 5,000 and 12,000, you know, we want to investigate the variability in the income and expenses as well, and the trends in those. So we'll notate any questions that we have related to the rent roll and to any financials that we have. It might involve a follow-up call with the seller or with the broker to kind of dive into those. Typically one pass of questions that we have everything we need to complete our underwriting. And then the final step is finally breaking out the model, you know, garbage in, garbage out. So we really try to put 95% of our time into getting good data, good assumptions to put into the model. And then we run everything through. So, and then into that, we include lending terms. If we're going to put financing on the property, we have income and business plan assumptions out into the future. So, you know, if it's a 100 pad park and there's only 50 homes in there right now, we're going to pull in 5 homes per year, every year for the next 5 years. That's going to be in the model. Any kind of business plan type assumption will be incorporated into the model in some way.
So what are some assumptions that you would have for a mobile home park? I'm not as familiar with mobile home parks, but, you know, obviously, you know, we underwrite multifamily, but what, you know, when we're looking at, if you sent me some underwriting for a mobile home park, I'm going to be calling you back and saying, okay, well, you know, what are these assumptions and how do we know we're going to get there? Right. So what does that look like on your underwriting? Yeah.
I would say on the expense side, I'd probably say that a lot of the operating expenses are probably pretty similar to what you would see on traditional apartments, or really probably a lot of different asset classes. Really on the income side is where things differ, in my opinion. One of the main value adds that we like is infill. So, and by that, I mean, we're buying a park that has a vacant pad and we are buying a home, moving it in there and selling it to somebody. And we like that because it is forced appreciation to a certain extent. And as long as we're confident in the demand in the area for homes, we can go out and buy 30 and 40 homes, move in there. We can dramatically increase the value of the property by doing that. And we actually have a infill manager full-time on our team that his job is only to move homes into our parks across our portfolio. It's that big of a component of our strategy. And then you also have, obviously you can reduce expenses in a number of ways. If they are, say they have Falcon season tickets and they're expensing $20,000 a year for that or whatever, you see all kinds of stuff. You're really trying to take the expenses, boil them down to how you can operate the property in the future and base it off that. And also another probably thing that would catch you off guard is there's a big distinction in mobile home park world between a tenant-owned home and a park-owned home. And so park-owned home being the park owns the home that's sitting there on the lot. Tenant-owned home being the tenant owns that home and is responsible for the repairs and maintenance. Everybody loves tenant-owned homes. That's really the sexy thing that's drawing people to mobile home parks. Because really you're just leasing the land to the tenants, much lower operational oversight, much lower expenses, and they really like that model.
They have to pay for all the repairs then.
Exactly, right. And you can imagine like say if you had a 40-year-old mobile home sitting there and you had to make the repairs on it, I mean, you can imagine the astronomical expense associated with that. Especially as they degrade over time. And so, we prefer the tenant-owned home model. And if we buy a park that has some park-owned homes, we try to eventually transition those into home ownership for tenants over time.
What about the lending terms? What kind of lending terms should we be underwriting for mobile home park like you're talking about?
Yeah, believe it or not, and this whole asset class was so I was just so ignorant about the whole asset class getting into it. Mobile home parks carry a lot of stigma associated with them, but they shouldn't. Lenders love mobile home parks. Agency debt is very active in the space. We secured agency debt on one of our parks just in January at 4%, which doesn't sound super great right now given the craziness, but at the time was just incredible. So you see a wide spectrum. You see agency debt at the top for more stabilized parks with higher occupancy, and down toward the other end, you see more local banks, portfolio lenders, credit unions, and interest rates are all over the board right now. And depending on the quality of the asset, you can see anywhere from low to mid threes to low to mid fours, probably depending on the park.
Okay.
Yeah.
Walker, what's been the hardest part of this syndication journey for you? We talked about how you got started and, from there to where you're at now.
I would say hardest part is, probably getting used to the tempo at which everything operates. So I came from, you might say traditional corporate America to a certain extent, and the pace at which things operate with our current operation versus that is pretty incredible, and can sometimes be overwhelming.
Slower or faster?
Faster, 500 times faster. It's last night we got a call back from a broker at like 7:30 and telling them we had to get them an offer last night to salvage the deal, and beat out another buyer. And stuff like that. It's constant reprioritization. We call it the shuffling of the stack. I might have 8 deals in the pipeline at any point to underwrite. But if a new one comes in and it looks hot and juicy, it's got to go to the top. And so it's a daily reshuffling of that stack, and reprioritization. And I'd say that's something that I've grown to like, but definitely took some getting used to. It's like a cold bucket of water in your face jumping over from the corporate America.
So what about, how are you all prepared for like a downturn, like maybe you're experiencing now, or, and maybe tell us about, how mobile home parks, are yours or just in general, either one, have been affected by what's happened recently.
Yeah. Yeah. And so when Brandon started this company, he knew that he wanted to get into multifamily syndication, or I'd say real estate syndication in general, and didn't know what asset class. He looked into a lot of different options, and he actually chose mobile home parks because of he believes that they are one of the most recession resistant asset classes. And, a lot of people have differing takes on that, but I tend to agree with them. And you see people in times of distress kind of notch down their asset class. And so with mobile home parks kind of being one of the lower asset classes, you're kind of protected. And actually throughout COVID, I mean, I was looking at a chart the other day. I'm pretty sure that mobile home parks have actually seen the best collection rates of any asset class throughout the pandemic, and which is kind of further validation for us that it is a strong performing asset class in a downturn. We've actually seen no effect at all on our collections today through the pandemic. Granted, there's a lot of stimulus money injected into the economy right now, which could be masking some of the impacts. So I like to throw that disclaimer out there, but we're very reassured by the performance that we've seen through the asset class in general and our park specifically throughout the recent pandemic.
How do you all guard against like some kind of downturn? What kind of reserve budget are you going to see on a typical park like that?
Yeah. It depends on the deal. Typically we don't ever want to be in a position to have to go out and make a capital call. We leave reserves within our fund as working capital, and then also have reserves at the operating account level. You can see CapEx reserves of $1,000 a pad or more or less, depending on the park and kind of the distressed nature of the park.
Of $1,000 per pad?
Yeah. In some cases.
Okay.
Yeah. And that's kind of a rule of thumb that we've developed internally. Could be, depending on the park, if it's very well stabilized and the quality of the utility infrastructure is great, and they're all tenant owned homes, I mean, your risk exposure is very limited in the way of operational and CapEx expenses. It's really on the collection side.
Yeah.
And so, we pride ourselves in having great asset management as well. Brian Murray is our asset manager. And as you know, I mean, asset management plays a massive role in the performance of the property, probably the largest role, I'd say. And I would say you got to have a strong asset manager to drive the performance of the parks.
Whole team's important, isn't it? You got to get the deal across the finish line before you can. The asset manager has a job, but man, is that job so important?
It is. Yeah.
So Walker, what's a way you've recently improved your business that we could apply to ours?
I would say something that we're doing right now actually is bringing on 2 to 4 people to help me underwrite. And this might be kind of a unique suggestion, but we basically are bringing on people to work in a similar capacity that I worked in to start with. So they're coming on for free as free interns for 6 to 12 months to gain experience. And I would just let people know or encourage people to think about that. Like if you're overwhelmed or drowning in your business, there are tons of people out there that are fully competent and capable that are eager to come help you for free. Like it's hard for me to believe, but they are out there, and it can be a win-win for both parties involved. So I'd say just encourage you to give that some more thought, if you're feeling the heat in your business.
How do you find them?
Yeah. So, I mean, we're kind of blessed to have Brandon's social media following, and we use that to find a lot of our folks. But I would say any real estate type groups, masterminds, or Facebook groups, post it everywhere you can. LinkedIn, I would say all those would probably be great avenues to try to find somebody. Yeah, and then just reach out to your network. I mean, and folks, rock stars know rock stars to a certain extent. So some high performing younger folks, or even other people in the syndication world, reach out to them and see if they know of anybody younger and up and coming that wants to gain some experience.
What's the number one thing that's contributed to your success?
Hard work. I'd say hard work. I'd say there's really just no way of getting around it. At some point there's just no easy way to get it. So at some point you just got to put your head down and not pick it back up until you get to where you want to be. And I'd say just keep after it.
I love that answer. Put your head down and keep after it till you get where you need to be. And yep, that's what I had to do. And like we said earlier, I think it's people mitigate or lessen what they feel like what they're going to have to do to achieve their goals. But just jump in and don't quit.
Yeah, I mean, it's people try to sell you on ways to get around that all the time, but at the end of the day, like I become more and more convinced by the day that there's no other way than just the only way is through. So just got to go through it.
How do you like to give back?
So I teach a weekly, it's kind of been delayed right now due to coronavirus, but teach a weekly personal finance course it's called City of Refuge here in Atlanta. It's a large homeless rehabilitation type center for ladies in Atlanta. And they move in there for 6 to 8 months, get their life back on track. And they have a lot of training and services for them while they're there. And this financial kind of literacy is just one component of that I teach.
Wow. Well, thank you for giving back in that way, Walker. Thanks for giving back to us today and just sharing your expertise. I've enjoyed hearing your story, and I just think, so many of the listeners and myself, it's so good for us to hear. You got to get in there and just put your head down and keep going, right? But then, in working for free, I can't remember if it was a couple shows ago, I had another guy that talked about working for free for somebody. And I've talked about it so many times on the show, numerous times, like be willing to get in there and learn. Right. Yep. That is paying you so much more than you think, being willing to do that. But then just how you went through, how you all look for a deal or find a deal and the documents and the different things that are important that you look at, whether it's assumptions or lending terms. But just grateful for that. Tell the listeners how they can get in touch with you and learn more about you.
Yeah. I would say definitely, you can find us on at opendoorcapitalllc.com. All of our team members are on there. And you can find out all about our existing funds that we're raising for. And all of our contact info is on there as well. So please feel free to reach out. I'm not super, don't have a huge presence on social media, but my email is walker@odcfund.com if anybody wants to reach out.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.